The earnings pause. The stock market ground to a wildly mixed finish today, basically holding in a super tight trading range as investors pause to just catch their collective breath. We are staring down the barrel of a massive week of mega cap earnings, plus a absolutely crucial Federal Reserve meeting, and honestly, the tension on Wall Street right now is palpable. Welcome to your Executive Market Debrief for Monday, April 27th, 2026. I'm your host, and today we've got no fluff, just the data, the core drivers, and the exact actionable insights you need. Let's get right into the headline numbers. Okay, let's start with the S&P 500, which managed to squeeze out a very modest gain today. We're up just 0.12%, adding about 8.8 points to close at 7,173.91. After that really strong rally we saw last week, today's session was entirely defined by one word: caution. Wall Street is essentially just sitting on its hands, strictly holding this tight trading range. No one wants to stick their neck out and make a massive directional bet just hours before the Fed kicks off its two-day meeting tomorrow.
And, a really similar story played out over on the tech-heavy NASDAQ composite. It advanced 0.20%, roughly 50 points, to close at 24,887.10. Again, a super modest advance amid all this broader caution. The buyers are definitely still out there, but they're being incredibly selective right now, clearly keeping their powder dry for the absolute slew of tech titans reporting later this week.
Now here's where it gets really interesting. Check out this divergence. The Dow Jones Industrial Average actually lagged behind today, shedding about 63 points to finish in the red at 49,167.79. That's down 0.13%. So why the drag? Well, the Dow is being heavily weighed down by some serious caution in a few specific megacaps, which we're going to dissect in just a second. But first, it's absolutely crucial to understand the macro environment driving all this hesitation. Over the weekend, those highly anticipated US-Iran peace talks completely failed to materialize. As a direct result of that, passage through the Strait of Hormuz remains severely restricted, causing oil prices to just climb aggressively. And look, this isn't just an energy story, right? Rising oil immediately raises fears that higher commodity costs are going to bleed directly into food and delivery supply chains. In a market that's already anxious about a two-day Fed meeting, inflation rearing its ugly head through supply shocks is literally the absolute last thing investors want to see. So, let's move into our deep dives to see exactly how this is impacting equities. First up, Domino's Pizza, the delivery miss. Just look at this technical damage. Wow. Domino's tumbled a massive 8.87% today to close at $335.51. And this wasn't just retail panic, folks. This was relentless institutional distribution. We saw volume exceeding 4 million shares just dumped on the open market. When you see a chart drop like this on that kind of heavy volume, it serves as a glaring red flag, not just for Domino's, but for the entire consumer staples and restaurant sectors. And this brings us right to the why. Domino's delivered a really disappointing Q1 earnings report, missing on both top-line revenue and bottom-line estimates. They reported earnings per share of $4.13 against the $4.31 the street was expecting. Remember that macro oil shock we just talked about? Well, this is exactly where it hits the income statement. With inflation still heavily squeezing lower to middle-income households and geopolitical tensions driving up delivery and food costs, Domino's is getting crushed on literally both ends of the transaction. Wall Street immediately punished the stock because, frankly, they're showing zero patience for consumer brands that simply cannot defend their margins right now. The big takeaway here? When wallets are squeezed and costs are rising, the market is not going to forgive an earnings miss. All right, let's shift gears over to the semiconductor sector. Advanced Micro Devices, AMD, the valuation squeeze. So, despite the NASDAQ's slight overall advance today, AMD dropped 3.83% to close at $334.49. This happened on seriously heavy volume, and AMD's weakness actually dragged down the broader semiconductor sector right along with it. What's super interesting here is the psychology behind the drop. This is a textbook example of a valuation squeeze driven entirely by pre-earnings jitters. Right now, AMD commands a massive premium multiple because of its association with the whole AI boom. But the market is intensely focused on whether AI infrastructure valuations have just gotten completely overstretched. Portfolio managers looked at AMD sitting at those premium levels and aggressively decided to take some chips off the table. They preferred to lop in their gains at $334 rather than roll the dice on forward guidance in such an uncertain macro environment. Basically, AMD proved today that when a stock is priced for AI perfection, investors would much rather take their profits than gamble on an earnings print. Finally, our third deep dive, Apple Inc., the mega cap de-risking. Apple dropped 1.27% today, closing at $267.62. Remember earlier when we talked about the Dow Jones totally lagging the other indices? Well, Apple acting as a primary anchor is exactly the reason why the Dow was pulled into the red today.
The most crucial point to understand here is that Apple didn't drop in a vacuum. It traded lower alongside other mega-cap peers like Meta and Microsoft as the entire sector braced for their quarterly reports. With the broader S&P 500 hovering right near record highs, Wall Street needs explicit confirmation. They are demanding hard, tangible data to prove that Apple's consumer hardware sales and their AI integration efforts are actually keeping pace with their sky-high valuation. Institutional money moves straight to the sidelines today to wait for that hard evidence. Apple investors basically hit the pause button, taking a step back until the fundamentals actually justify the premium.
All right, moving to part 3, the water cooler. Actionable market context. Here is exactly what you should say to your colleagues tomorrow morning about your market insights. If the consumer comes up in conversation, use this exact line on Domino's. Domino's dropping nearly 9% down to $335 on earnings is a huge macro warning sign. It shows that the geopolitical spike in oil isn't just an energy story. It's actively driving up supply chain and delivery costs for the restaurant sector, while the consumer is too tapped out to absorb higher prices. It's a great data point to justify keeping our consumer discretionary allocations highly defensive right now. When the conversation inevitably turns to tech and AI, drop this insight on AMD. Did you catch AMD dropping nearly 4% down to $334 today? It's a classic pre-earnings de-risking. The market is terrified that AI hardware valuations have gotten entirely detached from reality. Portfolio managers aren't willing to hold maximum exposure going into the print. It's a smart reminder that we don't need to chase semiconductor breakouts right before they report. Letting the dust settle on the guidance is the much safer play. And finally, for broader market sentiment, use this Apple takeaway. Apple sliding 1.2% to $267 is the perfect example of Wall Street demanding a show-me quarter. With the Fed meeting tomorrow and Apple reporting later this week, institutional capital is freezing up. No one wants to be caught offside if Tim Cook hints that consumer hardware demand is softening. It reinforces why we need to be patient with mega-cap tech this week until we actually see the AI CapEx numbers.
Domino's took an absolute beating today, dropping nearly 9% as rising food costs and a tapped-out consumer crushed their Q1 earnings. Do you see this as an isolated restaurant issue or a massive red flag for the broader U.S. economy? Comment below. Subscribe to Market Fluency for your daily edge.